Today is Saturday, and I'd like to take a step back and try to put some context around the global happenings on what's going on with every country. Not every country, but the countries that are important. So I want to say, before we start this, that countries all have something in common. They have their economy, they have their currencies, and they have their interest rates. And these three things are affected by two other factors that have come in. One is the inflation, and second, what are the tariffs? These two things are affecting the other three things. They all interact with each other, and then they interact with all the other countries, all right? So how you weight these things and understand them in your mind and what you think is going to happen, you have to make up your own mind, all right? All I'm saying is the three factors that we're going to look at are what are their economy, what is their currency, and what are their interest rates. Now, this was in the Asia Times yesterday, and they're saying that Japan's bond market, which you all have been watching, okay, has thrown all the world into a tizzy because we don't know where our safe haven is. And we've talked about this. There's four buckets where people go. You can go to America, Europe, Japan, or China. That's it. And given what's going on around the world, people are very unsure on where to go. So you can see here in the second paragraph, it says the number one and three economies, the U.S. and Japan, are being monitored by the bond vigilantes. And as we say, men propose, but markets dispose. And the investors in the world literally cannot make up their mind which of these major economies is more risky than the other one, right? And if you look, so you say, what do I want? The U.S. with Trump, they want Japan with their lost decade and their high inflation and their low interest rate, or you got China with rising deflation and persistent property prices and an enclosed system. So it's kind of hard to get in there and do what you need to do if you're a $1 trillion asset manager. So all three things. And then Europe, we all know, they're a unified currency, they're not a unified economy, and this is why they're always the fourth choice. The only thing of interest here I want to point out is that Japan has managed to raise their official rates to 0.5%. This is a 17-year high. And remember, we've already covered 9 to 10 years, they were actually negative interest rates. And you can see here, there's two lines here. The first one, the Ministry of Finance might reduce the size of bond issues. They have a big meeting coming up, I think, on Monday or Tuesday, where Japan's going to discuss that. And then Goldman Sachs says that the JGB market is a canary in the global coal mine for duration. So again, long bonds, all right? Now, the third paragraph is all we want to look at here. So their 10-year bond is now 1.5%. And their 30-year is soaring up to 3.16%. Go back. Where were we? We were 0.5%, and we're 1.5%, and we're 3.6%. What's the problem? Now, the top line observes that the Japanese yen is strengthening even as U.S. yields are rising. We consider this as evidence that foreign participation in the U.S. Treasury market is declining, which we've been talking about. But what I'm interested in is the third paragraph. Japan's GDP now is shrank down to only a 0.7% growth rate, with their inflation rate running at 3.6%. Their target's 2%. But think about it, 3.6%. You're 0.5% on your short, you're 1.5% on your 10, you're 3.16, all negative interest rate. So in no way, shape, or form should you believe that this currency is moving up. Yet, the yen is moving up. That is showing us that people are selling the dollar to buy the yen. And the last two lines point out that our tariffs, the U.S. tariffs that we're putting on Japan, is going to challenge them on their growth rates, but they're only growing at 0.7%. So our tariffs could send them into a recession. So how do they raise their interest rates to drive up the yen as we're asking them to do? In the fourth paragraph here, the bottom line, he said the demand for longer-term securities is diminishing at the same time the supply is growing. So, and by the way, look at the last line here. They say that this could be the moment for China to step up and fill the gap, i.e. become a world currency, We've discussed this in another video. We think sometime in the next 15 years, this may actually come about for China to take advantage of this, but the costs are huge for China and it remains totally unresolved. I don't think it happens for years. China has to have a SWIFT system where people can do transactions in their currency, not the CIPS system, which is trading commodities, but they're working on it. Now let's shoot over to the US. Now, when you look at our inflation rate since 2020, if you add it up, cumulative, it's 25% or 5% a year. I understand 9% in the beginning, and now the CPE is down to 2.1, and I think the CPI is down to 2.5%. But basically, it's at 5% for the last 5 years. Now look at the PCE, which is the favorite Fed Reserve metric to watch, came in at 2.1%. But this is for businesses. The CPI is for consumers, all right? So to understand, the last time that the US had 5% inflation, a total of 25% over 5 years, was in the 1970s during stagflation, which had oil shocks, wage controls, unemployment. It was bad. We've done videos on this. This is when I started in the business, when this was happening. Now, the PCE is the business inflation metric. And you can read this yourself, but I just want to go to the second to the bottom line. They say the PCE, what is it? What affects it, okay? And it's business inputs, materials, labor, supply chain, okay? So let me ask you a question. Make up your own mind. How is this going to remain at 2.1% given what's coming down the line for us when it comes to supply chain and materials, okay? And when you look at our consumer spending as of April 2025, you can see that, remember, the CPE minuses housing, food, and energy, okay? No wonder it's 2.1%, and no wonder the CPI for the last 5 years is 5%. All right? So whatever you want to watch, that's entirely up to you. But for individuals, 330 million people, this is an issue. But as we started in the beginning, no one knows really where to go. France is running out of money for social spending. And they could have a liquidity crisis if that could impact their benefit payments in the future. And you can see here in the second paragraph, that they're saying that it could affect France's ability to borrow on the financial markets. Then we look at the UK gilts. They were just warned by the IMF that they themselves are facing funding issues and they have vulnerabilities in the gilts market, including declining role of patient investors such as pension funds and insurers of holders of the long-dated bonds or gilts in this case. And you can see here in DeepSeek, they say that they're shifting towards shorter-term gilts, reducing long-term issuance due to concerns about the market stability and the risk of sudden sell-offs. Okay, so we have commonalities on the problem side. Currencies and interest rates, economy, all being affected by inflation and tariffs, okay? So everyone has virtually the same 5 factors going at ourselves. And then you have the demographics of the countries and so forth. But everyone is solving the problem the exact same way. How are they solving it? They're going to not issue the long-term bonds, which are under attack right now. They're going to issue short-term bonds. Now, anybody who follows this channel knows that we've always said that the central banks control the short end, the markets control the long end. So this is an attempt by all these central banks to try to control, rein in the long end by not issuing bonds. What's the risk here? The risk is what America is facing today. We have to raise between 9 and 11 trillion or 12 trillion, and 7 trillion of it is rolling that was short-term rates that were put on by Yellen. Your problem of issuing short-term is that they come due sooner, and if the interest rates aren't lower, you get buried. So what do we do? Tell me in the comments, and like and follow. And thank you for following.